Hi, good morning. Welcome to December's transaction review and calculator practice. Patricia, hey, good to see you. Hope you're doing well. Can't believe the holidays have just flown by so fast. What, couple weeks to Christmas or something, if that. All right, so in this one, I decided to talk about one of my consulting clients in a situation where I was actually working with the buyer. A lot of times I'm working with sellers. What they're trying to sell their property, and they're wondering, if they offer owner financing, how they should do that. Others are trying to figure out how they sell their note in full or in part. But sometimes the buyers need the help. So in this situation, I don't know if you can see this, but this is just the story here. The payer, now this buyer, this ended up being someone who was paying on a note that I bought a couple years ago. It was a note in North Carolina on a single family house. They had paid something like 45,000 for the property. Uh, no, I think it was more like 54,000 for the property. They put like 10,000 down, and I bought about $42,000 of the note was left when I bought it, and they recently just sold that house for like 150,000. They'd been putting a lot of work into it. And so they still can't get conventional financing though because they have a short sale that hasn't dropped off of their record. So they're down here you can see that their credit score was in the mid 500s. So FHA, they can't get a traditional loan at that point. So they knew that I was collecting their payments before. So when they were looking for another property, they found a good deal that was listed in another place closer to the coast on North Carolina, listed for 195. But these people they're out of state, and really the value of the property, if someone was patient enough, would probably be about 250,000. So even at the listing price, it was a good deal. And they got it under contract though at an 140 all cash offer, so an instant $100,000 of equity there. But the problem was from the sale of the other property where they paid me off of that note, they only had $105,000 cash. Only, I mean, that's great, right? But for that, not quite enough. So they said, Don, can you give us a loan? I know you do the loans because you were collecting payments, on that other note we were paying on. And basically, especially because of Dodd-Frank, the new regulations going into effect in a very heavy-handed way, starting January 10th of 2014, I will not do consumer loans. Most people consider that if you lend money to an owner occupant for their primary residence, anything 1 to 4 where they're owner occupying, you might as well shoot yourself in the head. It's a very risky thing to do. So almost, it's really quite sad because now, look, they have 105 to put down. They only need a 35,000 loan. That is super safe loan to do. But because of the regulations, they'd have to find someone who knew them, whose family or something, not a professional. So that's very sad that the regulations are protecting homeowners from ownership. So anyway, what can we do? So the last loan they were paying on their other property was 8% amortized over like, I don't know, 7 years, 8 years, something like that. They thought I could give them a loan for 8%. They don't understand that my yield when I bought that note, I was actually making 16 to 18% because of the discount that the seller took when I bought the note. So for his $42,000 balance, I only paid $32,000, which means the same monthly payment was yielding me at least, I want to say it was at least double of what the face rate on the note was. So, but they didn't get that. They thought that I made somehow an 8% loan. And we talked about Dodd-Frank. So I said, but we can work something out. It's just that you have to be willing to pay a little bit more for the property. If you can get the owners to carry back paper, if we structure the transaction. Anyway, I can't give you a loan, but I am willing to help you structure an owner carry note that will net the seller the same cash they are expecting in this $140,000 cash offer they were expecting. So buying this would be called a simultaneous close, a SIMO. sometimes they call them a SIMO, SIMO, or this would be easy from an underwriting perspective, right? Because me as the bank, the underwriter, I can look at this and say, oh, well, this is safe all day long. Not only do they have a lot of hard equity into this property, but they also have a lot of emotional equity because they're going to be living there all day long. This makes sense to bring $35,000 to the table in this deal. So from that, strictly just that perspective, it makes sense all day long. A SIMO note sale is also called table funding because basically, you're bringing money to the table to close the owner financing deal, sort of, within a few hours, a couple days at the most. But technically, this can be construed as origination. Like if I buy this note, if before the payers have even made one payment to the owners, then that could be 50-50 chance. If you speak to an attorney, they will say, then you did an origination. And so if that were the case, if I got one of the half of the lawyers that would say, yeah, that was an origination, then what that would do is require that I be a licensed mortgage originator and comply with all the conventional standards, where I would have to give them a fully amortized loan. I would have to verify ability to pay. I don't know, all sorts of those sorts of things. So just for you, this doesn't particularly scare me in most instances, but it's something I do have to run through my brain. So so that's a FYI. Okay. So then so they said, so what I got on the phone with these buyers, and I said, so what, you want to buy this property, what's the monthly payment that you would ideally like to have? And so she said, well, we'd like to pay the same that we were paying before, but we have a lot higher, we have HOA fees at this new place, and the insurance is higher, the taxes would be higher. So they actually had a lot less to spend toward principal and interest. So I took what they wanted, what their expected or perfect principal and interest mortgage payment would be, and then I reverse engineered some options for them. And then this is the email I sent to them. I just said, I've run a few options for you to consider. Once you choose the one that best meets your needs, then I can work with the agent. They were working with a selling agent who had submitted their offer, and I will work with the seller and his agent to understand the deal structure and get to closing on this. They originally just wanted to pay $400 a month, but I said it's a little bit too low. So if you can come up at least $100 more each month, then we can work with that. This should still keep your PITI, principal, interest, taxes, and insurance, and HOA at or less than the $900 you were paying before. And also they thought that sometimes they have big jobs that come in and they get big chunk change, but they don't want to have to count on it. So they wanted quite a long time, a lot of flexibility to be able to pay off early. So I ran a few different numbers for them, and here's what we're going to look at now. Okay. So here's the financial options. So what I said, basically, if you can afford, let me clear this. If you can afford $489, which is, almost $100 more than their perfect thing. So let's just put in, I'm reverse engineering this just strictly so far from the payment that they want to make. So I'm going to make this a negative number and stick it in the payment area here. That's how much they want to pay per month. And they wanted up to 15 years to pay out the loan off fully. So I'll put in 15 times 12, which is 180 here. And they said, we kind of want a low interest rate because then if we pay it off early, then we won't have paid very much interest. And I said, okay, well, let's run that number. And so then I have to figure out what would the loan amount be. Here's the loan amount. So $61,945. So I basically said your note amount would be $62,000. Okay, so that basically now you're going to have to pay a little bit more for the house if you want to customize and create your own long-term financing, because the sellers only want their cash and nobody can make you a loan. Okay, the banks won't make you a loan. Private parties are scared to death to make you a loan. So So I said, then you can do that. So basically, you'd have to pay your 105 down plus a $62,000 note, and their total cost for the house would be 167 instead of 140, right? They'd have to pay for customizing that type of financing. They'd have to pay what is that, 27,000 more for the house. But with the time value of money over 15 years, really they're paying a lot less than this, but most people don't see that. And basically what I wanted to show you was how I came up with this is I figured based on a long-term note, let's say 12 to 15 years or more, I is saying I'm going to be wanting a 15% yield. So here's what I did to figure out how these other things would work, right? So, okay, if I'm going to want 15%, and technically, that's a high yield for short term, that much safety, but keep in mind that I'm not charging them any points up front, and that's a long time. And if interest rates go through the roof 10 years from now, or 7 years, or even 3 years from now, that 15% might barely be keeping pace with inflation, maybe not even, right? So, the 180. So then, what did I say? Okay, they need me to bring 35,000 to the table. So that's what I said. I kept this number in here first, and this is the amount they're going to pay over that. And then I go, okay, well, what's my yield? Okay, so then I said, well, all right. So just to show you that part, we'll go back and forth a little bit. Then if you can say that no matter what their different things is, I'm only bringing $35,000 to the table. The face interest rate, this is how much they're going to pay for how many months. Okay, this thing, and this thing. I'm only bringing $35,000 to the table. They're paying this much, this many times. Okay, so then it's like nothing else changes. The face interest rate of the note doesn't change for me depending on how much I'm paying. I hope you can follow that. Oops. Follow that there. So then I said if you're willing to pay a little bit more interest, so let's go back to this 6.5%. If you'll pay a little bit more interest, then your P present value will only be 56. Okay, so instead of having a $60,000 note, you can have a $56,000 note. Your total price for the house is just $21,000 more. If you're willing to go up to 8%, like you were paying on the last owner carry note that you had, then let's solve for that. That's only 51. So now you're down to only paying 156 for the house. And in their mind, it's like, wow, that's expensive, or it's charging us $16,000 to get this loan. But what they're not seeing is the time value of money over the next 15 years and the fact that they had no costs. And we'll go that again. So you can see that here's different. This is the payment they want to pay, and they want this long to pay it off. They hope to pay it off in the next 3 years, but they don't want to have to. They want as low a payment as possible. So 5%, 62,000, 6.5%, 56,000, 8%, 51,000. So, and you can see on my side of it over here, maybe I'll just get this out of the way, that, regardless, based on a 15% yield and no upfront cost to the buyer, no matter what happens, I still same face interest rate 5, I still pay 35. Interest rate 6.5, I still pay this. 8, I still pay this. It's just that, because I think I already explained that. So if you have any questions, type them in and we can go over it again. Okay, so let's see. Then I said, well, if you can pay a little bit more, little bit more, then the numbers even get better for you. Okay, so I said if you can pay 525, and I probably reverse engineered this. Okay, 525, 31. Let's put that in the payment area here. Remember, it's a negative number. So is future value when you ever put that in. And maybe if we can amortize it over a little shorter term. So that's fully amortized over 12 years. So here we have a higher payment, a shorter term, and I know that if I'm receiving those payments, I'm bringing $35,000 to the table. Let me see if that eats my, yeah, so I reversed it that way. Okay, so if I bring $35,000 to the table, I want 15% interest rate for 12 years receiving this payment. Okay, so that's how we got there. So if they have a 5% there, they're paying that much. Let's see what their loan amount would be. So we'll click there. So their loan amount would be 57,000. Okay, so it's a little bit lower, right? Here's the lowest that they've got. If they'll pay 8%, and then the loan amount would be only 48,000, right? So their total cost would be only 153 for the house, but they're still saying, they still don't get it, which is like another red flag going, well, maybe then they're going to go to attorney and they'll say, wow, they're charging us like $13,000. Isn't that, so then you got to be careful of being a loan originator, because still I'm sort of discussing terms with the buyer, aren't I? So it's kind of a gray area there, so just something to be careful with. If I was just consulting with the seller saying, here's how you increase the purchase price of the house, offer to carry it, I'll discount the note, and you're out, and you'll get your 140,000. But since I'm talking directly with the buyer, they're looking at this like I'm charging them $14,000 today to get that. But of course, it's not. But it's hard for them to get that. So let's just do a comparison. Let's compare it. If they could get a private loan, if someone could do an origination to them, their loan amount would be 35,000. Maybe they'd be charged 5 points. This is like just standard hard money, especially for a small amount. To make it worth anybody's while, they have to charge usually 3 to 5 points, and on the smaller loans higher. So let's say they're paying $1,750 for points, other fees, originations, appraisals, $500. Maybe there's closing costs. They're half of the attorney or recording fees. So let's say they have to come out of pocket $3,500 at closing. So it's going to cost them, that much extra to bring in at closing. Interest rate 12%. The term is only usually going to be 2 to 5 years. I know very few hard money lenders, private lenders, that want to go longer than 5 years. Many will go that long, but they don't necessarily want to go longer than that. Some want their money back in a year or 2 years. Okay, so then, yeah, they could get this loan if someone wasn't afraid, from a regulatory standpoint. But then that's a lot of pressure, because if they can't pay off the loan in 2 to 5 years, then they're going to be in a foreclosure situation, a default scenario. Now that's pretty stressful, right? The monthly payment would be $350. It's less than they wanted to pay, but there's no amortization, reduction of the principal balance. The balloon at the end of this 2 to 5 years would be 35,000, but their total acquisition, low, right? 143, $10,000 cheaper than our best owner carry option based on the low payment that they wanted to make. If they would come with a much higher payment, it would have been a much different story, but they wanted to make a low monthly payment and have a long time to pay it off. If they could have doubled their monthly payment, then the numbers would have been pretty close to this, probably, I'm guessing. Okay, so on this side, the owner carry with note sale, if they went this way with their lowest payment amount, lowest interest, longest term, so the loan amount would be 62,000. No points. See, 1750 here, no points here, other fees, nothing here. Still same closing costs, just like a regular sale. So there's 2,500 less in closing costs, so they don't have to come out of pocket 2,500 right here. They have a 5% interest rate, and they've got 15 years to pay this thing off. So they're not going to get in a position, unless they quit paying their $489 a month. They're not going to be in a position of having a potential foreclosure sneaking up on them, right? Their payment's a little bit more. It's fully amortizing the loan, no balloon, but the total acquisition to them would be 167, which obviously looks a whole lot higher to them. So they had a choice to make. But you can see this acquisition price is still way below market value of the house. They have instant equity even at this price point. And so they had a decision to make. Okay, so then once they agreed to that, then They picked that option, by the way. So make instead of $140,000 cash sale agreement, they wanted to submit another offer. So I created a one-page, basically, letter of intent describing how this transaction could work. So basically, I said the closing attorney will handle both transactions. Here are the simple steps to closing. Number one, execute a new purchase agreement reflecting the new purchase price of 167. I think I said 162. Anyway, 167, and reference the seller financing aspect of the transaction. I will provide exact terms to help complete the seller financing addendum, which was 5% amortized over 15 years. So I know that a lot of the agents, even the ones that have been around a long time, really aren't very familiar with the seller financing addendum. It's a DRE, California Real Estate Association approved form. Many agents don't know the first thing about it. They're just freaked out. Okay, number two, sign the note purchase agreement that I will forward along with associated closing instructions. I will wire $35,000 to the closing attorney's trust account and make it non-refundable. So even before you close on the property and you agree to sell to these people, I will give my money up front to purchase the note before it's even created. So you know that if you're not going to be duped into holding a note you didn't want to hold. Number three, after the closing attorney is in receipt of the non-refundable $35,000, you will proceed to complete the sale of property in which the note I am buying will be created. Number four, from the closing of the sale of the properties, sellers get $105,000 less closing costs. From the closing of the sale of the note, the sellers get $35,000 less closing costs. Sellers net their $140 right there. They were willing to sell for $140 all cash. This is basically how they walk away with the same amount of money. These two closings can happen back to back, and literally they can. So all I need is the recording data from the original deed of trust or mortgage, and that can be plugged into the assignment, and then it gets recorded. And sometimes that can happen same day. Sometimes it has to be next day. So in reality, what really happened? They were excited about this idea, and so then they said, "Will you please talk to our agent, our buyer's agent?" And when I got on the phone with him, it was like I could tell that they weren't going to have a chance, because he says, "I've been in business 20 years. I've never heard of this, and I just, you know, I don't know, that this is not conventional, and I got to be able to protect my buyers." And it's like, when you have someone submitting an offer who has that attitude, I don't think I can go to the listing agent with this. And I said, "Well, do you mind if I talk with him?" No, you can't do that. And I said, "Well, great. Well, give it to an attorney. I know that this is legal in your state because I just bought a note. I had this other note in North Carolina that just paid off." So anyway, it was just an amazing amount of ignorance and closed-mindedness, and that's always profoundly discouraging. And so I think this deal never did go through. The buyers then were thinking about it and saying, "Look how much you're paying for that financing." They're not getting the time value of money there. They're not getting the fact that $489 that they want to pay 15 years from now might buy me a cappuccino by then, because of inflation. So there's a lot of things that were a little bit challenging, but that's just a way of showing you how when you understand the discounted note business, you can reverse engineer solutions, whether you're selling a property, buying a property, selling a note, buying a note. I mean, there's just a million and one ways to go. So I hope that was a little bit instructive. Thanks so much for being here this morning, and look forward to seeing you soon. Have a great holiday season. Bye-bye, everyone.